It is a pleasure to be with you today. As I've told folks the last few weeks, this is an especially positive message coming from me. But it follows up on my admonition: if you'll keep inviting me back long enough, I'll have good news eventually. But I was with the delegate body yesterday, and a kind of a strange occurrence happened. There was someone that mentioned that one of your pork princesses was actually related to Sam Carney. And I told people that pork princess and Sam Carney in the same sentence was kind of unusual. And then I told them that we had fences like that when I grew up too. So anyway, it's a pleasure to be with you. Let's get started here on key issues for this year. Okay. I think probably the number one issue that we're going to watch for this year on hog markets is what happens to pork exports. Of course, that was a remarkable run this last year. We're going to end up somewhere 24% up for the year and exporting about 22 to 23% of our total muscle cuts. If you add in variety meats, that number is going to be up around 27% or so. The keys on that are going to be exchange rates, trade policy issues, and really that's the actions of our trading partners. The things on the free trade agreements that we've had in 2011 are terrific for the long run, but most of those take 10 or 15 years to get into place. We'll start working and implementing the Korean free trade agreement, I understand, here during February, but it'll take a while for that to really take roots. Of course, disease status in the long run has an important advantage for the United States relative to Brazil. I just saw where Taiwan had a foot and mouth disease outbreak again last week, and so, staying clear on those is an important thing every day. So we need to be mindful of that. U.S. demand is another factor. The first half of this past year was excellent. It certainly softened as we went through the year. We'll talk about that here in a moment. But the prices of competitor goods this year, I think, is going to be an important factor in the demand for pork. We'll talk about specifics, but we should see much higher priced beef. We have to believe that at some point, higher chicken prices will go up due to these reductions in output. And if that's so, it should help U.S. pork demand. Feed prices are kind of like the poor, low. They will be with you always. And high feed prices in particular, they're not as high as they were last summer, but we still have to watch that. We're just one bad crop away from having astronomical feed prices. That's kind of the world we live in. South American crops have garnered quite a bit of attention this year. The moisture situation we'll talk about in a minute. And of course, 2012 acreages and yields are going to be important. Hog supplies, it's kind of nice to be able to rank hog supplies number 4 on a list of important factors for this year. Given the December Hogs and Pigs report with relatively modest breeding herd growth, I think the keys are going to be productivity and herd health, and of course weights as far as the impact on production. But I don't see us getting burdensome pork supplies at any point during this year. We'll talk a bit about packing capacity, though, as that could be an important factor over the next couple of years. All right, crops and costs. The first thing that happened this year that really drove this situation was we had some poor weather, we had some trouble planting, then heat in the summer, the dead of summer, July and August, and we ended up with a yield that was below the trend, about 6% below the long-term 1960 to 2010 trend, about 8% below what I call the biotech trend that goes back to 96. I think the longer-term trend is more useful because it includes some years with bad weather in it. The biotech trend does not include bad weather years. And still, we still ended up with almost $6 corn at the present time, and some futures at one time that were up in the $7 range with this kind of yield. USDA, in its last report last week, increased that yield by a bushel from their previous estimate, I guess a half a bushel. It was a bushel over where the expectations were. That increased the crop. It did not have a material impact at all, though, on projected carryout as USDA increased exports. They have feed and residual usage at 4.6 billion bushels. They have ethanol at 5, consistent with a year ago, and yet 6.7% stocks-to-use ratio at the end of the marketing year has these prices up here in the 570 to 670 range is what USDA is predicting, and that's what we're seeing. Now, at the same time that they released these production data, they also released a grain stocks report that shocked the market pretty heavily. 250 million, 260 million more bushels than what were expected in December 1 grain stocks. The implication of that is that feed usage during the September-November quarter was down 10 or 11%. I don't see how that could happen. Hog numbers were up actually during that quarter. Feedlot inventories were up during that quarter, about 4% across the board. Chicken numbers were down, but as I posed in a column a couple weeks ago, how many chickens could you feed with one steer? Well, the answer is a lot. And so I don't see how they ended up with 10 to 11% down on feed usage, especially given the fact that they kept the year's feed usage number steady, and it's down 4% from a year ago. So some of this is not internally consistent, and it causes some problems. But we've also seen the market sell off quickly due to that, and what's it done? It's bounced right back to just about the levels it was before the reports. So I think there was some impact, obviously, but it looks to be pretty short term. On the usage side, here's the usages by category, feed and residual being the purple line, and you can see it trending downward. Even if we put the DDGs that are being produced by that ethanol usage in on the feed supply, the total feed supply in the United States, when I take corn, oats, milo, barley, DDGs, and feed wheat, the total feed supply is going down. Now, long term, that means only one of two things. We either get more efficient or we get smaller. So far, the poultry and meat industries have coped with that by getting smaller. In the long term, the question is, can we increase efficiency enough that we can grow with a shrinking supply of energy type feed ingredients? The ethanol businesses last year was driven by profits. Ethanol plants made money for virtually all of 2011, which is important. The renewable fuel standard was not the reason that we used 5 billion bushels of corn last year for ethanol. Now, the renewable fuel standard has played an integral part in building those plants that use that, but we weren't just making ethanol to meet the mandate last year, and it doesn't look like we're going to be making ethanol to meet the mandate this year with $100 oil. There's some math that doesn't work very well, though, and that is, we have this program for domestic energy production, and we're exporting 1 billion gallons of ethanol a year as of last year. It's a strange situation, and this is what happens when you have policies that send different signals. We exported 1 billion gallons of ethanol, and we imported some ethanol from Brazil at the same time we were shipping product to them. Of course, a lot of that's the reason because of California's requirements for the carbon footprint of ethanol production, a requirement that a judge set aside a couple weeks ago saying it violated the Commerce Clause of the Constitution, so that's going to get run up through the courts, I think. But still, the ethanol situation, not as complicated as it used to be. The blender's tax credit and the tariff are gone. We still have the renewable fuel standard. The point I would make is that the proposed off-ramp of the renewable fuel standard that's in Congress right now that says that should projected year-end stocks-to-use ratios meet certain thresholds, we'll set aside a portion of the renewable fuel standard, up to half of it, would not have had any impact last year. It would have said that we'll reduce the renewable fuel standard by 25%. But that wouldn't have affected the market because we weren't making ethanol to meet the renewable fuel standard. We were making ethanol because it paid. And it paid because oil was $100 a gallon, a barrel. Might be a gallon pretty soon, but not quite yet. $100 a barrel. So the important thing is to watch the economics of ethanol as to whether the renewable fuel standard will play a part. Worldwide, corn stocks projected to be among the lowest in history, and thus we have corn still well up into near $6. If we look at what's projected for the rest of this year, based on futures, I believe these were Monday's futures, this would be Omaha corn using a historic basis, still down toward $5 toward the end of the year, but at record levels except for 2011. As we look forward to the 2012 crop, the concern is this. That 2011 drought did a pretty good job of spreading northward during the year last year. Note the date on this. This is November 22nd. And if we update it to last week, here we are now. We still have a pocket in southern Minnesota and northwest Iowa that's very dry. And I was in Minnesota last week, and a lot of people really confirmed that. I live just west of town here. There's a river called the Raccoon River that runs right through Adel. I've lived there 18 years and I've never seen it as low as it is right now. And I've talked to people that are been there a lot longer than I have. It drains a good portion of north central, northwest Iowa. And so it's important to note that we do have very dry conditions, especially on subsoil moisture. We're going to have timely rains, I think, in those areas to raise a good corn crop this year. The rest of the Corn Belt's still in pretty good shape, but certainly not anywhere near as good as we've had in the last few years here in Iowa. The soybean situation was not changed much in the reports of January 12th. A little bit of a reduction, an increase in the yield. It increased the crop, increased carryouts, though, by about 25 million bushels because they reduced the amount of crush. So still, we're going to have very high soybean prices, even though when we look at the world soybean situation, much better than the situation with corn. And so when about any kind of computations you've done with soybeans and corn for the 2012 crop, we're going to get a lot of corn acres because corn wins and wins handily in most cases. Bean meal somewhere in the 320, 330 range right now. I think you could see that stay there. It could go up a bit as we go into the spring planting season, depending on those acres. The other one that we in Iowa don't tend to pay much attention to that I think we need to watch now more than ever is the wheat situation. And the world wheat situation is much better than it has been the last few years. Again, near the top of projected world ending wheat stocks, mainly because of a rebound of the Black Sea countries. If you look at the price of wheat relative to corn, it's close to record low, and it's stayed there for a pretty good amount of time. Is it going to stay there for a long time? I think it's likely that it will, because these kind of wheat prices make wheat profitable in other parts of the world. And wheat can be grown a lot of places. We're going to see more acreage and more production. And so the relatively cheap wheat. Now, what does that mean to an Iowan? Well, maybe not much, other than somebody in some other part of the country is going to use some wheat instead of some corn that they would have used in the past. And so I think you need to be more cognitive of this than we have been. DDGs had a real spike in price this fall. Had a few of us scratching our heads saying, gee, has something changed here? And then just about that quick, the relative price of DDGs to corn came right back into a range which it's been in for about 3 years, which would be a competitive feed ingredient for hog diets. I think the spike up during the fall was really caused by a lot of cows in the Southwest being on poor quality hay and poor quality or non-existent grass. And some feed companies bought a lot of DDGs trying to get ready for the winter. It went right back down, and so I think we're back into this that you can kind of count on DDGs being affordable in your hog diets. Projected costs up in the $83.50 range, about $3 per hundredweight on a carcass weight basis, lower than a year ago. Like I say, lower than a year ago, but the second highest on record is the projections for costs right now using the Iowa State University production parameters. So costs this year are going to be high, not as high as last year. You're going to have some chances. You had some chances to lock in corn in the fives. I don't know that you're going to get many more of those kind of chances unless we see large plantings, which that is being forecast by virtually everyone. I think Informa had 94.2 on theirs, 94.2 million acres. I wouldn't be surprised to see that number well up above 94 as we go through the spring. And we had good weather with a rapidly developing corn crop this year. Then you could buy some corn cheaper as we go into the fall. Take the flip side of either one of those. If we don't get that 90-some million acres planted and we get some lousy weather and you've got very high corn again. I could see corn starting with a 4 sometime this year for sure. But I could also see corn starting with an 8 sometime this year. So a very risky situation. And again, I think you need to manage that risk according to your ability to handle it, both financially and just your risk preference makeup as a person. Okay, meat and poultry demand. As I said a while ago, this has been a highlight in the first half of the year and kind of not so good the second half. And part of that is the recovery that was clipping along pretty good as we entered 2011 certainly has not clipped along very good since then. And it's GDP growth has slowed. It's been a problem that we've seen across the economy. It's you've read about it in lots of places. Per capita disposable personal income actually declined during 2011 after growing during late 2009 and 10. That takes money out of people's pockets, and so, if you look at spending as the combination of ability and willingness to spend money, the ability part in mass in the U.S. Got a little worse this last year. If we look at where we are relative to consumer sentiment for that willingness factor, not very good most of 2011 as it went down, but we've seen a bounce up just in the last couple of months on the University of Michigan's Consumer Sentiment Survey. Now, I put this on a graph of the unemployment rate just to show that those two are pretty highly negatively related. And so as long as that unemployment rate is high, it's going to be hard to get people feeling very good about things. The unemployment rate has dropped, and the last month of data here, December, was a pretty important one because not only did the rate drop, but total employed increased in order to do that. The 2 months before that, the rate had dropped, but the reason it dropped was that the workforce got smaller. In this case, it didn't, and so that's kind of positive, and then something that I hope we can build on as we go through 2012. The demand indexes that we compute, all up for the December through November period. That's the last month that we have full data for. Dr. Plain at Missouri estimated December exports and imports and came up with numbers very similar to this, which you can understand that. I've got 11 months of that data in these indexes. But you can see of the three species, the pork demand was about as strong as any, or stronger than the others. The real problem is this is a tale of two halves of the year. All of that strength, if we go back and look at these numbers have continually gotten smaller since July. So that 12-month period, July through June, was pretty good, and it's gotten smaller and smaller and smaller as we've added months that did not do very well. And you can see the second half of the year for pork, the second half of the year for chicken has been negative. Beef has held in reasonably well, okay? But still a strong beginning of the year, softening as we've gone through, and I think we're going to see this. It's important that the macro numbers turn around a bit to get some more consumer spending. We've seen the restaurant trade turn, at least the outlook for that, from restaurant operators as measured by the National Restaurant Association's RPI, or Restaurant Performance Index, improve the last couple of months back above what they consider to be an expansionary number of 100. So hopefully that's leading, and it will be a bit of a boon, an improvement on demand as we go forward. This scatter diagram kind of shows where we've been. You notice that the big move for 2011 was a reduction in the quantity of product being consumed by Americans. Now, is that a problem? Well, I would not say that 1 year in itself is a problem, but the reason that they're eating less pork is because you brought them less pork to eat. And you brought them less pork to eat in two ways. Number one, you produce less than you used to. And number two, we've exported a lot more than we did before. Now, I heard a consumer group that was griping about high meat prices a few weeks ago, and one of my responses would be, okay, we've got people overseas that will pay us for the product. If you don't pay us as much, we're going to sell it to them. And so that's exactly the decision we make. Now, does that mean that demand is bad? No, it doesn't, because the price is higher. In fact, if you compute the change in quantity and the change in price, that 2011 observation is on a slightly higher demand curve than would be the 2010 observation, indicating what the demand index has told us. But the point to be made is, and if you look at the beef diagram, it looks just like this. On the chicken and turkey side, they have not reduced supplies, and their prices have not improved. Okay, and so they're about in the same boat they were a year ago or worse, and they need to reduce supplies in the same manner if they're going to get their prices up. Now, turkey's not in bad a shape as chicken, but still, the point is that we've reduced the offerings of meat to consumers, and in our case, our prices went up enough to say that that demand remains strong, even though per capita consumption goes down. By the way, again, I'm going to take this in isolation. You don't want this to continually be the case, or you become the lamb industry, which has per capita consumption, I think, of about 1.5 pounds per person now. Okay? So you can't continually reduce supplies to drive up prices, and I don't think we're going to do that this year, but it's going to be very close. It is a real good illustration of the difference between consumption and demand. Retail prices, this is the other side. The reason that reduction is not necessarily a bad thing, because demand is constant, is that we've been able to get record high pork prices, the pink line here. record high choice beef, record high all fresh beef. Notice that the one that hasn't improved is the red line for chicken. I think it's pretty remarkable that beef demand and pork demand have been as good as they have with cheap chicken available as it has been in 2011. It really is. But we're going to see the chicken price, well, I darn sure hope we're going to see this chicken price line start up to kind of match some of these others. And these beef lines, I just changed the scale of my graph to include $5 here, John. And I figured I might as well just get 6 while I was at it, because we're going to get a pretty good portion of the way up there as we go through this year and next. The dollar index has been the value of the U.S. dollar has been an important factor in exports. A cheap dollar makes our goods less expensive to foreign consumers, and we see that the dollar has strengthened some, but is still historically weak. A stronger dollar and a strong dollar are two different things. And while the dollar is stronger, it is far from strong, and I think it's still going to leave us in pretty good shape on exports. This index is about 58% or so the euro. So it really measures what happens to the euro, and you can kind of trace all of the European debt crises through here. There was the one this last fall with Greece. We've had some strengthening since then, because I don't think the markets think that the Europeans really have any handle on this situation at this point. I don't see the dollar strengthening dramatically. I don't see it falling completely out of bed either. I think we're going to stay in this range, and so that should leave us in good shape. If we look at our currency relative to our competitors, you can see that the real, the dollar is strengthened to the real and the euro, a bit to the Canadian dollar, Australian dollar, but again, a stronger dollar and a strong dollar are two different things. If we look relative to our customers, the yuan and the peso have both lost value relative to the dollar, and the peso is significant. That's our number one volume total pork variety meats and pork customer, and our number 2 value customer. And their currency has lost value pretty dramatically. And if you see the rankings of exports this last year, we got plus 170% or something like that to Korea, doubling to China, Hong Kong. Mexico is I think it's plus 1% for the year, just about the same as it was a year ago. So the performance has not been as good there, mainly because of a weaker peso relative to the dollar. Still in very good shape relative to the yen, and of course the Chinese currency would probably strengthen dramatically if it was allowed to float. It's already record strong. And it has been allowed to gain about 20%, but that's over a 7 or 8 year period. So it's nothing to write home about. Exports, again, 23% up. These forecasts are from the Livestock Marketing Information Center. I can tell you, I think if we hold our own on exports this year, that ought to be a victory. This much growth the past year, some concern about a little bit stronger currency. If we could match 2011, I'll take it. There's by market. We can see China, Hong Kong, the big driver, Korea earlier in the year, but we can also see the fickle nature of the China-Hong Kong market. And I think we're going to see that again. Hopefully it won't go down as much as it did the last time, but their pork prices have been falling for the last 6 to 8 weeks, and so everything I hear is that those shipments have slowed pretty dramatically. I threw this in because I don't know where else to put it. This cold storage report last Friday. My take on the cold storage report was that this number right here was really encouraging. Total pork and poultry and cold storage on December 31st, the lowest since the summer of 2003. We finally got reductions in the amount of chicken in cold storage. The pork number was not out of hand in any way, shape, or form, and so I don't think that these stocks certainly aren't burdensome and might be a little supportive to prices as we go through the spring. All right, chicken. Could be worse. You could be in the chicken business. This is our estimated broiler return since 2007. And you can see they made some money, broke even for a while, decided they didn't like that. Well, they ended up with some profits, moved into an expansion phase. This was after Pilgrims made all of their cutbacks. They started to get some profits, moved into an expansion phase, and ran smack dab into $7 corn. And it's not been a good 15 months for the industry. Our estimates are they're back just about break even. Some of them might be making a little bit of money, but not much. Christine, I see you shaking your head. You've been with those guys recently, and that'd be where you'd think they are? Okay. Just about break even. That's not a very good thing. The real problem is They started cutting back, and they really responded pretty quickly to this. I was kind of surprised. They started reducing egg sets back in March. I think that's March, April, somewhere in there. The red line goes well below the green line. The red is last year, the green is 2010, and you can see some huge reductions in egg sets as we went through the year. They started reducing placements a month after that. I don't have the slaughter and production numbers up here, but they started reducing slaughter 2 months after that. It all fits together. The problem is they didn't reduce production very much at all because the weights of the birds were high. They went up last fall with the expansion. The expansion was almost all in big boning birds. Everyone decided they wanted heavier chickens. And they got heavier chickens, and they've kept those heavier chickens in spite of these reductions in numbers. And so what has happened? Production has stayed closer to the year earlier levels than have any of those other measures, and they've kept pressure on this marketplace. If we look at their broiler cutout, I compute that based on the prices of the parts. It did get back above 90 cents finally here, okay, which is good because it's being carried by leg quarters and by wings, which wing prices peak out at the Super Bowl and then fall off the face of the earth normally. So that's not a good outlook for this thing. But the real problem is this one. Boneless, skinless chicken breast still at $1.30, and they really haven't gotten any traction. That is the product that they were shooting for with those big birds, and it's the one that right now is an albatross on them that they've got to overcome this long term. You have to think they're going to figure that out at some point. Christine McCracken with Cleveland Research shaking her head. No, they're not going to do it. I sure hope so because they need to get some price traction. They have cut back output, not by as much as I'd hoped, and they certainly, as we can see here, haven't got much pricing. And it's that price that is the lever that would have impact on pork demand. Okay? So until they get some action on price, we're not going to get a whole lot of help there. And chicken will remain relatively cheap and a real value for consumers. Cattle, on the other hand, is kind of going the same direction with output and is getting a whole lot more traction on their prices. The smallest cow herd last year since 1963, the cattle inventory report comes out day after tomorrow, 2% down probably, John, is what I'm thinking. And 2% on the beef cow herd is a bunch. That is a huge move on the beef cow herd, and I think that's what this report's going to say Friday. The calf crop this year, we've had the 4 smallest since 1950. We're going to have a smaller one for 11. We're going to have a smaller one for 12. The numbers are going down, and of course, this is the big driver. The drought, this was in June. It reached from Arizona to North Carolina. It touched about 45% of the beef cow herd, and it touched 27 or 8% of it in Texas and Oklahoma with a hammer. It was extremely bad. I grew up in Oklahoma. I was there July 30th for the Oklahoma Cattlemen's Association meeting. It was not a happy meeting. That week, most of them, 2 or 3 of them told me they could not find trucks to get cows hauled to slaughter because they were all booked either hauling cows to slaughter or hauling cows somewhere else to try to find grass for them. It's really a bad situation. I know some large ranches in the Texas Panhandle that moved 4,000 and 5,000 cows up into Nebraska and South Dakota where there was lots of grass this year. So at least they had the opportunity to do that. And I've heard tales that if you were in central Nebraska this summer, your number one risk was getting run over with a truck of hay going south. There was a lot of hay moved around, and necessarily so, to try to support this beef cow herd. Beef cow slaughter ended up 11% for the second half of the year. It was up about 5% for the entire year. And so you're going to take a lot of cows out when you do that. The cattle on feed report says we still have 3% more cattle on feed on December 1st, 3%. That was the estimate. The actual is 3% on January 1 than we did a year ago. Now that's the closest we've been to a year ago since last spring. And the reason is that drought took out the wheat pasture last year, so we moved a bunch of cattle into feed yards. That's exactly right. They do. Those cattle, some of those just went to market not long ago. We had a huge slug of lightweight cattle that went on feed in July and August because there wasn't any grass for them. So they're going to get counted on reports all the way through probably February or March, some of them. So we still see those cattle in yards. This is a segment that had excess capacity, and yet it's been full up most of the year. And so it's kept the guys that own feed yards in business. But these numbers on feed are eventually going to run out, and you can see that placements during December we're down almost 6% from a year ago. Once this bunch of cattle is gone, there's not very many feeder cattle to follow them up, or a significantly lower number, and cattle supplies are going to get very tight as we go forward. Here's the year-over-year comparisons of feed yard inventories. You can see the dramatic increases last summer. We're still here. We're going to get work back to year-ago levels sometime here this spring, and when we do, you're going to see cattle supplies get very tight, and I think you're going to see prices go higher. There's slaughter per week. Per capita U.S. consumption, which is per capita U.S. availability of beef, down about 3.5% per year for the next 2 years, should push prices dramatically higher. And we already set a record for the choice beef cutout in November at 196 and change. Those of you who listen to me, I've been saying since last summer we're going to see $200 choice beef. We're still going to see it. We might see $215 or so choice beef sometime in the spring. And $215 choice beef, I think that's $133 fat cattle, John? $134? I think that's in the offing. I think we could have that happen. So, if the chicken people can get their prices up, I think beef prices are going up. I told CeCe Snyder, the Vice President for Marketing at the Pork Board this week, that there's an outside chance she could have record price loins and be the feature article on retail features. I don't think that's really a wild idea. We set the record price for loins last summer. We could do it again this year if these prices go up, and that still could be a feature item at retail. Now, that's a pretty good world to be living in if you can get high prices and still be featured. Okay? So, we'll see if it happens, but I think there might be a chance. Okay, hogs. Well, the December Hogs and Pigs report said that all of you are being very, very careful about your output as you go forward. We don't see much expansion. The breeding herd up 0.4%, a little smaller than what was expected. The market herd kind of as we thought, a difference between the expectation and what actually happened on the 180 and over category, but the expectations were all screwy there. This number was about in line with slaughter during December. The two numbers that I kind of focused in besides the breeding herd was this March-May farrowing intentions of 99.1, which really doesn't fit with the breeding herd or the two previous quarters, and the fact that we only had growth rate in litter size of 1.1% for that quarter. One of them, I think, is a shaky number, the farrowing number, that says that fall supplies will be about as they were this year. The other one says we've slowed down on growth, and I think that's a dangerous limb to climb out on, because we're still on a path of 2% per year growth in litter size, and that's been going for 4 years. And I think the incentives are in place to keep that growing. I mean, we still have expensive corn. We still have a sow market that pays us to be rolling gilts rolling sows out and gilts in, and thus adopting new, better genetics at a rapid pace. I think there's a lot of reasons that, I know some of you are dealing with PRRS, and I know that's a bad thing during the winter, but in general, when I take the view over time, what I hear from veterinarians is the herd health situation is about as good as it's been in the United States. And so there's a lot of reasons to think that we're going to keep doing. Lastly, the Danes raise 11.3 pigs per sow per year, and we're still at 10.02. Okay, we got a lot of room improvement still. So while we're patting ourselves on the back, somebody better be kicking us in the tail, because we can still make up a lot of ground on this. And so we need to be aware that if we keep going at 2%, we don't need very many more sows. Okay, to keep this thing with plenty of supply for the market we have. Here's the growth of the number of market hogs in each quarter's report relative to the breeding herd. You can see a lot of gains here as we expanded the breeding herd and we got circovirus vaccines. But coming off of that, we had to reduce the breeding herd to pull these back down. Now we're still back on that trend of doing more with the same breeding herd, but roughly every quarter. What does it mean for slaughter this year? Well, those numbers would say that we're going to see some growth through the first 3 quarters, and that farrowing number for March through May says that the fourth quarter slaughter should be a lot like last year. Now, I think we have to entertain the idea that that farrowing number was too low by at least 1%. We're going to get another couple of shots at it in Hogs and Pigs report, but if we are, that would put us up 1.5% or so for the fourth quarter. And notice here is slaughter capacity as estimated by my survey last April that we published in National Hog Farmer, and that says about 2.35 million head per week or so. And so, we're challenging slaughter capacity. We're going to challenge it again in the fall of 2012. And I'll throw out there and say, and what if we grow 2% more pigs by the fall of 2013? It could get quite tight. And so I see that as one of the factors we have to keep an eye on. Weights are going to stay high. They shifted up the fall of 2009 when we got fresh corn. I thought last year we'd drop back down some. We haven't done that, and we're going to build some more finishing buildings to provide some slack to feed these pigs in. We were very tight this last fall, and so I think we're going to keep weights. I'm factoring in weights kind of the same as a year ago, with some improvement possibly in the summer. That all depends on weather, of course, and we pulled them back pretty dramatically because of weather this last year. Pork cutout value spent almost all year last year above $90, bumped into $110. I don't think we're going to get to this high. Now, that all depends on what happens. That was driven by the Chinese in the market last summer. If they were to jump in again, we could see it again, but I would say we're not going to get quite this high. Somewhat lower maybe in the fourth quarter of next year. Producer sold hogs spent the entire year above $80. Remember what my estimate for cost this year is, 83 and change. So we have a chance to be profitable for most of the months, most of the weeks of this year, I think, as we go forward. Sows, I think you can count on these prices staying somewhere in the $60 to $70 per hundredweight live weight range for the big sows. So a little bit less on the smaller sows, but still really high value on these sows. They are a unique product going into sausage business. You cannot duplicate the color and texture and fat to lean ratio of sows using trimmings. You just can't do it. And so they're a unique product. There's not very many of them out there anymore, and there's not going to be any more to speak of in the foreseeable future. And so these sow slaughters chase them pretty hard, and they've kept their prices high. As of day before yesterday, futures for corn, soybeans, this is the same cost line you saw a while ago. And here would be the price line for hogs. Only a small losses in the fourth quarter would be in those monthly figures. Average for the year of about $12 per head profits. Again, assuming the Iowa State University parameters. There are farms that if the average forecast is 83, they're going to be in the 75 to 77 range on cost of production, and so they would have another $10 or so per head profit on top of that for this coming year. Generally a very good year relative to where we've been in the past. Here are quarterly price forecasts. These are mine. I forecast national net weighted average or negotiated price on the weighted average, just the negotiated. I don't throw in the contract pigs here because this is the spot market. This is Missouri's. They're forecasting a slightly different one, as is LMIC, the Livestock Marketing Information Center. Notice we're not too far apart, though. I'm a little bit more optimistic than they are. And here's where futures were last Friday, kind of right in those ranges. They'd be pretty close there now. I don't see there being a lot of pricing opportunities at the present time, just because the futures are kind of where I think cash is going to be. Now, if you've got a balance sheet that says you can't stand as much risk, you may want to take some of these profit margins on a portion of your output for that time period. Normally, we see the hog market, the whole futures complex trade higher as cash markets move higher in the spring. And normally, you get a better chance to price summer hogs later in the year than you do in January or February. It's usually not a good time to be locking in prices. So I'm saying be very cautious about that at the present time, but you also want to keep a good eye on your finances and make sure that your financial structure can handle risk. Here's where we are on prices so far this year, as well as monthly forecasts based on those quarters. And you can see, I think the first half of the year is probably going to be better than last year. The second half, I think, a bit worse as we get hog numbers closer to year-ago levels. So, pork output, 2012 supply is a little bit larger. If we can maintain exports, our per capita consumption will go down a little bit because of population growth. Had a Rick Perry moment there. I don't intend to quit anytime soon. So anyhow, with the bulk in second and third quarter, fourth quarter steady. Again, quite dependent on that March-May farrowings number. Weights, I think they're going to remain in the 200 to 210 pound range. We have the genetics to do this efficiently. Even at expensive feed with these kind of hog prices, that marginal value. The marginal value is probably greater than the marginal cost, since that's basically feed costs. Questions, will demand hold? Obviously, competitor prices are a positive. The economy, I think will be a positive. It's been a drag the last 6 or 8 months, but it's improving some. The U.S. dollar, I think, is going to stay relatively weak, helping exports. Consumer sentiment's going to be a big driver here. Is there enough finishing space for added pigs? I think we're getting there. The mild winter has certainly helped that from a construction standpoint. Very tight supplies of finishing space last fall, so we do need some more. And finally, this issue of slaughter capacity, and I've got fall of 12 on here. Not terribly concerned about that. I'm much more concerned about the fall of 2013. There is more talk about Triumph getting their plant in Moines started than I've heard in a while. That kind of comes and goes. I remarked yesterday that thing's been put on hold more times than my weight loss program. But still, hopefully we're going to get that plant started. Now, if you stuck a shovel in the ground today, I don't know if you could kill any hogs by the fall of 2013. I think it's pretty shaky. Probably sometime in 2014. But we will, if we're going to grow, we're going to have some more slaughter capacity. And there are some double shift possibilities at a few plants. Haven't heard much talk about that. I do know that Hormel now owns some ground next to their Fremont plant. That would help, but I haven't heard any plans to start any work on that either. So there's nothing going on that I know of. Okay, risks. Well, the economies are big risks, both the U.S. and the world economy. Whoops, let's go back to that. The exchange rate is a risk issue. I'm not too worried about it, but it's something we ought to watch. 2012 corn and soybean crops, every year we're going to be on the cliff seeing what happens on these crops, and so that's always going to be on the list. Oil prices, still a risk. Corn is hitched to it. It's high enough now to cause a lot of corn to flow to ethanol. I don't know if you'd get more corn flowing to ethanol if we get in a shooting war over the Straits of Hormuz. I don't think it'll take long to eliminate the Iranian Navy, but we'll see. That could still drive oil prices higher. The RFS waiver reduction plan, who knows what chance that stands in Congress. Probably not much during an election year. I don't know that you're going to get attention to this matter. The proposal is, as I said before, at different levels of the projected stocks to use, we would set aside some of the renewable fuel standard. Now, that being said, it wouldn't have had any impact last year, and it's really designed to help a situation where we have low-priced oil and high-priced corn. In that circumstance, the market would say burn gasoline in the cars and feed the corn to livestock. The policy won't let that happen. Now, if oil is high and corn is high, then we're probably still going to make a lot of ethanol, even if this thing kicks in. We might reduce the renewable fuel standard, but again, the economics will drive production. I would argue that's the way it ought to be, okay? But at least this would give us an out in a case if we really had some low-priced oil or lower-priced oil at a time we had a short corn crop. Of course, an export disruption would be very, very serious. An OIE disease, like foot and mouth disease, classical swine fever, the only way you can protect yourself against that is to try to use the price insurance mechanisms that are out there, whether they be futures or options or livestock growth margin insurance or something like that you could protect your prices in the case of this. Because even if you're not in the area that has the disease, all the exports are going to get shut for some period of time and prices are going to fall out of bed. So that's about the only thing you can do. So that's another benefit of locking in pricing on some of your pigs out front, is that if we had one of these disruptions, you would be covered on the price side. Now, I think this is real unlikely. I think we've proven it's unlikely. Every time another country has one and we don't have it, but I have to say that probably during my lifetime our luck will run out. I think it's been since 1929, is that right, since we've had foot and mouth disease in the United States? It's been a long time. Very few people remember it, thank goodness. But still, we have to always entertain that could happen. Another swine flu type scare, who knows? I was just at the pork board day before yesterday, though, and heard the Center for Disease Control, some others have come to some agreements on renaming influenzas. And they're going to rename them according to the genes involved. And if they're different, they're going to call them variant, and they're going to quit talking about what species they came from. Now, that does not in any way control the press, okay? But at least the scientists will not be using swine flu in the future. And that should help us some should anything ever happen again.